Welcome to the Profit Answer Man, Tom Anderson. It's great to have you join us today.
Thank you, Rocky. I'm really glad to be here. I look forward to the visit we're going to have.
And I am excited for the conversation. Can you tell us a little bit about yourself and your business?
Certainly. I have been a CPA originally from public practice with one of the largest firms in the international space, and spent about 7, 8 years doing that, and then wanted to go and help businesses from the inside rather than from the outside, as a CPA is often left to try to do. And consequently, I became involved in a lot of turnaround work during one of the economic downturns that the U.S. economy and the world economy faced. And so I had that interesting experience of helping to represent predominantly private business owners with their banks and investors and others who had lost some confidence and some faith in just what they could do under those circumstances. And so with 25 plus years as both a CEO, a CFO, and sometimes a chief operating officer as well, I've worked in a variety of commercial and industrial environments, a lot of blue collar as well as services and even some technology. And in many cases, we either had a transaction with private equity or we had a minority interest private equity placement that also changed the alchemy a little bit in the relationship and such. So I've actually had a chance to experience that as well.
You've got a varied background, and I guess what I'd really like to understand, because you've sat in all these different seats and sitting where you sit now and talking to business owners, where do you see the struggles are between the CEO and the financial person and how they view things differently, and how should they have great conversations?
Well, to some extent, I put the onus on the CFO, to be honest. I think a lot of them tend to be very technically competent, very capable in a professional way, but many of them and the best ones are not, and the best ones are good storytellers. You have to be able to communicate in a non-financial way to people who otherwise don't have the same depth of knowledge that that CFO has in order to be appreciated and understood. Two people can say the same thing and be academically correct, but one is understood and valued, and the other one isn't necessarily devalued, but they're not exactly understood. So the value of what's being communicated is not appreciated.
Is that what you think the problem is with most CPAs when they communicate with business owners? Is they've got a different language, so to speak?
I think in many cases, I'm fond of saying, and it's been said by others before, but accounting is the language of business, but everyone doesn't speak accounting. So you've got to be able to decipher what is accurately being depicted in the accounting and what's going on as a CFO as well in the both macro and micro side of the business's economy, and put it all together in a way that can help enhance not only what's happened in the past to be understood, but how to chart a path forward strategically.
And I think that is really the key, is that forward looking viewpoint. And I think that's why a lot of business owners struggle with their accountants, because they're always looking. Again, it's not their fault. If your person's nothing more than a tax accountant, of course they're looking backwards. They're not there to help you look forward. And I think that's where we get into a lot of trouble. And we'll talk about that in a moment. But understanding the focus of the person who you're working with, and finding the forward focused financial person.
Well, there's some very savvy public practitioners that are CPAs, and if they have enough time, or for some other reason they really know the CEO personally, they know how they think, they know what they know, and they know what they do not know, and they're able to maybe accelerate that communication process. But for most CPAs, they don't have enough time, face time, one-on-one time with most of their clients to become a a nuanced business advisor They may be able to give them great guidance on tax efficiency or how a particular pronouncement in the accounting standards is going to affect their business, and they certainly might understand the banking covenants. But putting it all together and relating it to strategy, you have to be one of the members of the team, I think, on a regular basis. Maybe not full time, but at least significant amount of time that you're actually picking up the nuances in the business, not just what you see on paper.
And that makes a lot of sense. And I think that's been a shift over, I'd say, the last 30 or 40 years, where CPAs have gotten so busy they don't have the time to actually understand the business owner and take the time to have the conversations. At least that's what I hear from my clients.
Well, it's true, Rocky. And then in some cases, if they're performing an audit, they have independence restrictions. So they have to be very careful that they don't cross that line.
And that makes a lot of sense. You deal with a lot of mid-sized family business owners right now. What are you seeing currently with your clients? What are they experiencing, and what's kind of that business climate out there?
Well, I think there's sort of a typical short list menu that pops up most often. Many have moved on from the COVID malaise, and there's some are still struggling on how to engage with their employees, especially the middle management group, as some of those opinionated generational differences are really manifesting themselves now. And some business owners, leaders, even in senior management, are still at a loss of how to overcome that and be effective. That's one. We certainly have had a period where inflation played out on a lot of businesses. Some were pretty nimble and managed to move prices up and still hold their business. I worry today that some will, and I've been giving counsel to some about how to manage it as inflation then begins to abate, and how not to fall victim to simply price shopping. The importance of having a value proposition, not just a price proposition. And then, very importantly, again, getting back to if the company is fortunate to have a CFO or someone in that role, the importance of creating what I call a management report to be reviewed by management rather than simply a financial report that might be wanted or needed by the banks and others, and you have to have both. But a management report can provide a lot of insight as to what's working, what is not, and also about what's important to the owner as well as to someone who might be extending credit, for example.
Can you explain the difference between a management report and a financial report?
Certainly. So, starting with the easier of the two, I suppose, a financial report is what most all business owners have been accustomed to seeing and receiving, and whether it be from their outside accountants or whether it be from their ERP system, it spits out the typical balance sheet, income statement, and maybe a cash flow statement, and a few other ancillary reports like accounts receivable, aging, and so forth. But my experience is in that the typical private business owner in the space that we work in, and even some that are larger, while they really know their business, they really don't understand a cash flow report in the way that accounting pronouncements require it to be presented. And most of them only barely understand at that maybe the nuances of their balance sheet. They're fixated on the income statement and the cash in the bank, and often are proud about all of their long-term assets that they own, but they don't understand how all of those things ultimately influence the real financial health of their business. And then in the case of a management report, it's intended to address all those issues. Number one, it's a mechanism to take accounting and convert it into something that the people in operations understand, the people in sales understand, and respectively how each one of them influences not just the profit of the company, but more importantly, the value of the company. Because ultimately, despite what happens to many, it's not necessarily the net income of the company that's important. It's whether you're adding value to the worth of the business. And those two things can sometimes diverge from one another.
Could you give us an example of how they might diverge?
Well, certainly. A company, for example, a very simple one, a company can certainly be making a profit, but distributing all the money to the owners, the shareholders, or an inordinate amount of that profit, thereby basically starving the business for growth capital. Alternatively, what some businesses do is they just borrow more, and the bankers are willing and glad to lend them more, but all they're doing is adding debt, which when you look at it on a valuation basis, they may well not be really increasing the enterprise value of the business at all. They may just be, in effect, borrowing more and taking out more. Another area where a lot of business owners get caught up, particularly if they're operationally oriented, which many entrepreneurs are, they they see a great deal to buy a new piece of equipment, a truck, whatever, and it is maybe a good deal, but they don't understand how making an investment in that is going to affect their liquidity, their the capacity to utilize all of that at the beginning. It's a long-term investment that is going to be measured somewhat by short-term measures, and so a lot of times they have a rude awakening when their liquidity dissipates and they have to run to the bank for.
In it, yeah, they tend to see money, they spend money, right? They don't think about, and it's kind of shocking, but most business owners don't really think about building cash reserves, especially large cash reserves. Um, and you've probably seen this. I see this. Business is a roller coaster. Things go up and down. And it's the business that can survive through the down is the one that has longevity. And if you're tight on cash, that's the number one reason that things are going to fail. As long as you have cash, you can live to another day. But if you don't have cash, it's over. And business owners, I don't know why, but they seem hesitant, except for Warren Buffett, to hold on to a large amount of cash.
Right. Well, Apple has a chunk too,
They do.
but Rocky, I think cash and availability of cash are really the way I like to look at the liquidity part, and it's okay to in effect um, utilize credit where you feel comfortable that you have the assets to sustain it. But in the end, I try to get my clients to define how much liquidity they need to have if they don't have any earnings, any revenue. Is it 6 months? Is it, basically, and have that number. And then as we go forward, we measure up or down against that number. And if their liquidity trend is running negative to that target, it sends off an alarm and we go, wait a minute, we've got to make some changes here because this ultimately will result in a problem.
What do you think is a good liquidity target? 6 months enough or
Well, every business, as you say, is a little different. The more volatile their business model is, where are they vulnerable to things that they cannot control? And the more of that, the greater amount of liquidity they really should maintain. And the liquidity can be maintained outside the business by the owner, for example, but it has to be available and committed and not something that is necessarily earmarked for other things.
and I think the other thing though is having that alarm bell to say things are going south long before they go south. And I think that's important. And that's what I love with Profit First is because it puts all the money in buckets, it gives you an alarm bell months before any other system would give you the alarm bell and says, hey, you got a problem coming. You got to do something different.
Exactly. And a lot of it is that owners again focus too much on the snapshot of the moment. It's the P&L for that month, that quarter, that year. But that's just like a horse race. It only tells you when the nose crosses the finish line whether you're ahead, behind. It doesn't tell you what went on during the whole rest of the race. You have to basically see a trend. And trend analysis, I think is critical to 5 financial fundamentals that I try to get owners to focus on. And in addition, and that's part of the management report, is liquidity is one of those, operating cash flow is one of those, valuation is one of those. What term debt capacity do I have? Is it increasing? Is it decreasing? What do I have available if I have an opportunity or a need? And so the idea really is to have focus on what everyone in your management team has done for that period of time you're measuring, but also how is the long-term trend of the business looking, to your point.
And that's one of the things we do. And I don't know that a lot of people do this, but we look at the balance sheet from month to month to month to
Right.
see what the trends are every single month and how they're going. Most people think of the balance sheet as a static statement, and they never actually compare it monthly over time to see how the changes are occurring.
And some of them, even if they look at it, they don't understand what it's telling them. That was sort of my comment about the traditional cash flow statement. They see all those things. They see that cash is either going up or down, but they get lost in all the detail of all the nuances of what's going on. And to some extent, they have a hard time separating what's going on in the root business from what other decisions they're making, which have nothing to do with
Hmm.
like
So,
distributions.
yeah, well, and honestly, depending on my business owner, we create this line that we call yeah. Yeah, that's a business expense. And we put it on there so that they can see how much yeah they're doing.
Right, right.
And a lot of times I'll tell you, I think the business owners are shocked at how quickly things get out of hand with that line. I know I am with my own business, right? I go,
Yeah,
oh, yeah, I spent a lot of money there.
yeah, yeah.
That's not part of the core business, and you have to be aware of that, and I think that's the biggest thing. So how do you find the right financial people to be able to do this as a small business owner? Because most small business owners, I think, struggle. And a good financial guy, I mean, let's face it, if you're a good numbers guy, you're in high demand. So it also creates that dichotomy.
Well, I think it's a matter of first assessing the business as to what their needs really are and make sure that you understand if a financial role is really needed or not. And in some cases, it may be a fractional or a part-time role for a time period and grow into a full-time one. Either way, I like to counsel my clients with the idea that it's kind of like buying a truck or a machinery. You're not going to use it 100% on day one. You're going to start at some fraction of 100%, but over time, you should get full capacity as you grow. But without it, you can't grow, or you have to hire it in at a much more expensive, less accurate basis. And you haven't really created a management strength that has value for the business. When you just rent, you don't really have certainty as to what's available to you, and usually if you rent long term, that asset is not perfect for purpose. It's just the closest thing you can get, but it may not be what would be ideal. So in a financial role, first assess what the business needs and how much of it. Then understand, of course, industry mores and things that are there that you need to understand if you're going to hire someone. But the truth is, I think you can be a darn good accountant, but not a good account communicator. But a financial officer has to be able to talk to people outside the organization and inside, many of whom inside have no clue about accounting or finance. But they actually are the ones that are driving the results in the business, not the CFO, and they are the ones that need to be able to talk about it, understand it. So a CFO, a good one, will actually teach middle management how to talk about their business in terms that others will understand.
And I think the other people who need to understand are the salespeople, because depending on how they're compensated, if they don't understand the need to drive solid gross profit, they'll give away all your profit and discount. And so aligning their compensation with your profitability is definitely an important part of that.
No, I agree. I think the best case, you have a short-term incentive plan and you have a long-term incentive plan. And you might restrict the long-term to a more selected group, including lead salespeople. But the whole idea is to make them think long-term and value it, and also keep them around.
Do you think most small businesses think in the long term?
No, unfortunately, or if they do, it's too late in the game. They have a need to maybe have an ownership change or some other issue. And you need 3 to 5 years at least to pull that off correctly. And if you wait until you have a life event of one sort or another, or you just there's a problem that needs more quick resolution, a lot of times you're not prepared.
And that's why we tell businesses the best business to run is an exit ready business.
Very true.
Because if you're exit ready, you're not stuck in the weeds, you've got good systems and processes, your business becomes more fun and you don't want to exit, but you can when you need to. And should somebody come along and offer you some ridiculous amount of money, you can always take it and run. So, but you've got to be in the place to be able to do that. And I think that's the key.
Well, in our firm, we believe and counsel with our clients often that two-thirds of their value is going to be associated not with the earnings and the EBITDA, but basically the people that are generating it and how strong they are and committed to stay with the business. I've seen businesses that had a nice financial result, but they had not created any kind of a management capability. They couldn't sell the business unless they were going to sell themselves with it.
And nobody wants to do that. I can tell you that is always a bad outcome for the business owner because they go from owner to employee, and nobody who's an owner wants to be an employee.
It's hard on everyone else too. So I agree.
It is. So how do we as a small business build a good team and figure out how to do that and be able to compensate the people?
Well, I think first of all, you need what I mentioned before, a management report. And that management report would require that people that lead sales, people that lead operations, or if you have divisions, each person leading the division would be a direct contributor to the results of and what's reported in those management reports. Not only that, should come to the monthly, quarterly, whatever review meeting, and they should speak to their part of that financial result and compare it to what was the goal, what was the budget, whatever you might want to call it, and what is working and what is not. And finally, what are they going to do about the things that are working well, and what are they going to do about the things that are not? So a management report should answer three things: what, why, and what are we going to do next? And if that management report isn't doing that, well then it's no better than a financial report. So the CFO is sort of the one to collect all that, but the CFO should not be the author of all that information. It has to come from the management team leaders, and they have to know that they are going to speak for what they're responsible for. And as they do that and practice it, they actually become more skillful. If you have to raise money or you have a buyer, they come in and interview these people, they talk to them, they know they can communicate to them, that buyer or investor, about what's going on in their business. They don't have to have the owner to, translate everything for
It's
them.
funny. I think the number one reason I see failure on Shark Tank is they don't understand the numbers. They can't explain them.
Right.
Or they give numbers and everyone scratches their head and goes, "I don't think that's real."
Well, it's either that, Rocky, or the person presenting can't explain it in a way they could understand it, which is my point.
Exactly. So you've talked about a little bit about PE, and I think, everyone always talks about wanting PE, but I always think there's a little bit of a downside because they've got a very different attitude. I'd love for you to kind of speak to how do they tend to behave?
Well, certainly, and I've worked in portfolio companies for private equity owners. I've also uh, negotiated with them on the sell side to one of them as a buyer. So I've seen them in a couple of different scenarios that I think is, confirming what my opinions are. So number one, I think private equity has been a great thing for liquidity across many, many private businesses, and that there's been a great result for many owners who chose to associate with private equity. However, the ownership perspective of most, not all, private equity companies is relatively intermediate in term or length at best, so 5 to 7 years. And that's because their investors expect to see their money turned over and either returned to them or reinvested in something. So they know that whatever is being told of them is real in terms of a return. So when you have a short term or intermediate term perspective on every business decision, there's some really good business decisions that are not going to be invested in because the private equity guy is not going to get a return until 10 years. It may be a great return, but if they can't see how they can get value recognition for it sooner than that, then they'll choose to defer or not invest in that at all. So for a family business owner or an owner of a business, they've never had to think like that. They're used to making a good deal because it's a good deal, and they haven't worried about whether it was 3 or 4 or 6 years. I mean, those are just time periods, but what matters is that it's a good opportunity and one that would fit in well. So private equity brings a lot of good things, and yet they also have their own issues. If they have a lot of redemptions in their private equity accounts, that's going to create a lot of pressure on them, just like your bank. If you have that, it may have nothing to do with you, but you can be negatively affected by what's going on in their world.
And I think that's the one thing a lot of business owners don't realize. And we saw that in '08. When times go bad, banks call loans.
That's
And
right.
depending on what your document says, it might be totally callable. And unfortunately, if the economy's bad, you're probably maybe struggling, and then the bank piles on. And even though you've been making all your payments on time as agreed, it doesn't matter. And I think there's risk there that needs to be dealt with, um, that they aren't always aware of.
Very true. And particularly lines of credit, Rocky. A lot of owners correctly want to have a line of credit, maybe for that liquidity availability that I mentioned, but they're not really using it. They might have 3, 4, $5 million at the bank, but they never use it. So the bank sits there and goes, "Well, we got all this exposure. One day they may wake up and draw down 5 million because times are tough or whatever." And so it makes the bankers nervous. And not only that, the bankers have to set aside some of their capital at a certain cost in order to just satisfy the regulators that those lines of credit are appropriately capitalized. So as a result, sometimes even if they don't call your loan, they reduce that $5 million line of credit down to one. Well, that is a very unsettling moment, and that's happened, including recently with Silicon Valley Bank. There was a lot of that started to go on as well, where lines of credit were just being summarily reduced, not closed, but reduced, and it had nothing to do with that particular borrower's situation, except they were not using it.
Hmm.
So,
Well, and I don't want to tell them to use it because I don't want them to go more in debt. So it's that catch 22, but even if you do use it, they can still call it and lower it and demand
true.
payment up front. So,
Well, the
you
best
know,
medicine is bankers in the end, like all that are running a business, they want to have more business rather than less. They're just managing risk. So the best thing to do with a banker, and a lot of small and middle-sized businesses don't do a good job of this, in my opinion, and that is have a more formal, not not formal, but reasonably formal, well-organized meeting with your bank every quarter. Invite them to your office, have them sit there and present to them what's gone on in the last 3 months about the business. It's a management report for bankers. It is, they already have the financial statements. They already have the borrowing base. They have all that. But what they want to know is what's the story behind the story. what's going well with sales and why, and what's it like out there with trying to hire and all of that. And they don't see that in their balance sheet or their P&L. They might suspect it, but rather than leaving them to wonder or worry, if you're falling victim to some of their less creditworthy customers have fallen your victim to, you reassure them and show them before there's even an issue. So they have a lot of confidence. They know what's going on in your business. So you're the last person they're going to cut, not the first one. That's,
And that is important. And I find most small businesses don't proactively build a good relationship with their banker. Um,
yeah, and if
it,
they do, it's also a lot of times, Rocky, it's lunch or golf. That's fine. That's social and all, but if you bring in the bank officers, maybe not the president of the bank, and you just give them a slide deck of 10 PowerPoint slides that shows them kind of this what's the story going on in the business, they go back and put it in their file and they feel like, golly, if I get asked a question about this credit, this customer's already given me what I need.
and that's the key, right? Keep them
Yeah,
happy and
well, they're
they'll
your
keep you
partner.
funded.
You got to treat them like a partner.
That's definitely important. Is there anything we should have talked about but didn't get a chance to?
No, it's fun, Rocky. I appreciate the subjects we've touched on. And what I would like to tell your audience is if I can answer further questions or nuances, please contact me at ferguson-alliance.com, which is our website. And I'd be glad to field any questions. We do that all the time without any formal engagement. Be glad to chat and see if there's some advice or referral that I can offer.
And I encourage people to do that. Thank you so much for joining us today.
Thank you, Rocky.
Thanks for listening to this unedited video of the Profit Answer Man podcast. If you'd like to catch the full episode and learn more about what we do, check us out at profitcomesfirst.com. We also go through the Profit First book in each and every chapter in the beginning episodes of the podcast, so check those out as well. Thanks for listening, and here's to you having a more profitable and growing business.